How to use real estate to avoid W-2 taxes. Most people think rental property losses can offset their W-2 income. They cannot, unless you know this loophole. In 1987, the government created the passive activity loss rules. They separated income into two buckets. Bucket one is non-passive income. That includes your W-2, your 1099, your stocks, and your crypto. Bucket two is passive income. That is rental real estate. The government drew a line between these two buckets. Passive losses cannot cross over to offset non-passive income. That means if you buy a rental property and generate a $200,000 paper loss from depreciation, you cannot use that loss to offset your W-2 income. The loss just sits there, useless. There are only three ways to get around the passive activity loss rules. Exception one, you make less than $150,000 in adjusted gross income. Most high earners do not qualify for this. Exception two, you sell the property. When you sell, you can use the accumulated passive losses to offset the capital gains. Exception three, you qualify as a real estate professional. To qualify as a real estate professional, you need to pass two tests. Test one, you spend 750 hours per year in your real property trade or business in which you materially participate. Test two, you spend more than half your working time in real estate. If you work a 40-hour per week W-2 job, you would need to spend 41 hours per week in real estate. That is nearly impossible for most W-2 earners. But there is another way. Under IRS Code Section 469, short-term rentals do not count as passive activity. If your average guest stay is 7 days or less, the IRS does not treat it as a rental. It is treated as a trade or business. That changes everything. You do not need 750 hours. You do not need to spend half your time in real estate. You only need to materially participate. There are 7 tests for material participation. The two most common for short-term rental investors are: Test 1, you work 500 or more hours per year on your STR business. Test 2, you work 100 or more hours and more than any single other person. That second test is less than 2 hours per week. Guest communication, coordinating cleaners, managing bookings, responding to reviews. If you hit 100 hours and you do more than your cleaner, your handyman, or anyone else, you qualify. Now here is where it gets powerful. When you buy a rental property, the IRS says you must depreciate it over 39 years for short-term rentals. On a $600,000 property, that is about $15,000 per year in depreciation. But a cost segregation study changes that. An engineer comes through your property and identifies all the components: appliances, fixtures, flooring, landscaping, lighting, cabinets. These items do not last 39 years. They last 5, 7, or 15 years. With 100% bonus depreciation back as of 2025, you can write off all of these components in year one. On a $600,000 property, you could identify $150,000 to $200,000 in bonus depreciation immediately. This is the tax code working exactly as written. You just need to know the rules. Your 9 to 5 funds it. Short-term rentals multiply it. This is how the wealthy stay wealthy. Ready to keep more of what you earn? Step 1, follow me. Step 2, comment SMART. Step 3, check your DMs for the free training.